Thank you, Jeff, for having me on this program. So financial independence, I would say, is relative and also not necessarily absolute. And financial independence speaks mainly to the point where you are able to meet your financial obligations without necessarily having to work to be able to meet that expenditure. So you get to a point in life where either you have businesses or you have investments that are running and generating returns that are able to meet your financial obligations. And that is when we say that you are financially independent, because what you do does not impact necessarily how you meet your financial obligations. And it's relative because what I term as my financial obligations may be in the tens of thousands. Yours might be in the hundreds of thousands. So it's not an absolute number, but it's more of how you're meeting your daily financial obligations, whether you need to work morning to evening to be able to do that, or you can actually afford to sleep and then still meet your financial obligations.
Okay. And then maybe what I want to follow up from that, from you, KB, is why would somebody want to achieve financial independence? Why is it important to achieve financial independence or even aim for financial independence?
So we have an adage, if I would say, in Akan that says, from entihoda. In other words, good things are not permanent. So for now, we have an able body, we have a job, we're working, and then we're getting some money coming through for us on a daily basis. The truth is that a time will come when we may not be able to work, or we may not have even the jobs that we currently have. And if we take the pandemic as an example, when it occurred, friends in the hotel industry, some almost lost their jobs, and as well as other institutions as well. So in such a time, what will work for you is how much of your salary or the monies that came through your hands, how much of that you have kept for a rainy day. So financial independence is important because we need to plan for tomorrow. And what we are doing now may not be there for us tomorrow. And then secondly, we have the strength to do what we are doing now. But a time is coming where we may not have that same strength to do what we're doing. And for those who are in formal employment, at age 60, you will have to retire. And when you retire, your expenses don't retire. And in fact, as you age, you have more of medical bills or health bills to take care of. So because our financial obligations don't decline and don't end as we age, it's important that we look at financial independence. That point in our lives where our expenses and our liabilities can be taken care of, not because we are working, but because we have planned for it.
Okay, I think that summarizes it in a very pungent point. You mentioned something with regards to those who are in formal employment going on retirement at 60. How about those who are in informal businesses? For example, the lady who owns a shop, the gentleman who imports cars and sell. How important is financial independence for this segment of individuals as well?
Right. So for such people, they determine how long they want to work. But the truth is that we will not be at the same capacity of our health status for life. And even if you take a footballer, you will be at your peak, and at a point in time, anything can happen where you will not be able to play as you used to play, or you may have lost the opportunity to even sign on a new contract. For those in the informal sector, anything can happen to the business at any point in time, or you may not be healthy enough to be able to go every day to do the same kind of job that you do on a daily basis. Because all these things are not predictable and they can happen at any time, it's important that each and every one, whether formal or informal sector, you actually plan for tomorrow, where you will be able to live your normal life without having to depend on you working as you used to be able to meet your financial obligations.
Okay, but that sounds to me, KB, like a goal, which will take a lot of effort to reach, if you want to put it that way. How long does it take to reach the level of financial independence? Generally, do I have to earn very high income? Currently, does my salary has to triple, for example, before I can get there? Or how long generally should it take for somebody to reach financial independence?
Let me start off with Napoleon Hill from his book, Think and Grow Rich. He said that many people wish for riches, but it is only a few who know that it takes a definite plan and a burning desire to achieve wealth. So financial independence is possible. How long it takes will depend on the individual and how the person is committed to his own goals or objectives. But I might say that time is the greatest multiplier of investment value. So the longer time you have, or the longer time you have to work, it gives you an opportunity to be able to do more in terms of compounding of your investments with interest. But if you don't have the benefit of time, I mean, we all have different ages. Someone at 50 in a formal employment has 10 years to retire. Someone at 25 in a formal employment has more years to retire. So I would say if you take age 60, which is the retirement age, whether you're in the formal sector or informal sector, subtract your current age from that number. It gives you an idea of how much time you have to be actively working to be able to reach that goal of financial independence. It does not necessarily mean that at age 60, you should stop work. No, but it means that in planning your financial wealth journey, or in planning your financial independence journey, this is the kind of timeline that you should be looking at. So the time is dependent on the individual, and it doesn't matter how old you are, you can always start. There's a proverb that says that the best time to plant an oak tree was several years ago. The next best time is today. So it depends on the individual, but more importantly, how much commitment and focus that the individual is in achieving this financial independence.
Okay, that's actually very elaborate. I was gonna ask a follow-up question, but I think your last point actually responded to that. Viewers, I would like to encourage you to also put up your questions if you have. Kindly put up any question you may have in the chat area or the comment section so that we can read it out to Kwabena Boama, so he responds to it. I see some of the questions coming in already. Let me also encourage you that you can follow Axis Pension Trust on all our social media handles at Axis Pension Trust in order that you get updates and financial tips whenever necessary. And KB, we would like to continue with the questions. And as you ended with the proverb on when is the best time to plant a tree, an oak tree, does it mean in general, for example, that younger people should rather take up the challenge or the goal of financial independence a little bit more seriously?
Well, I'd say all ages, but the younger people have an advantage because of the benefit of time. And then also, more importantly for the younger people, because when you're young, there are more things that attract your attention as far as money is concerned. So then we want to pay particular attention. And let me say this, a friend of mine once in a discussion said that if you don't fear God, God will fear you. But thinking about it, I realized that this is also true when it comes to money, especially for young people. If you don't fear money, money will fear you. In other words, if you don't respect money and how you spend money today, a time will come, money will run away from you. You can't even have access to it, all because you haven't put in place the necessary steps. And I'm sure we'll discuss that on how to get to that financial independence we're talking about.
Yes, great. Okay, so, and again, I see a couple of questions coming in already. We'll address all the questions before the end of the session. But for where we live in terms of our geographical location, i.e. Africa, and specifically Ghana, with all the economic hardships that we face as individuals and as a country, do you think, however, that financial independence is achievable, especially for the average Ghanaian?
Let me start with this popular quote, and I'm sure your audience might have read it or heard it elsewhere. Robert Kiyosaki said that from the book Rich Dad, Poor Dad, it is not about how much you earn, but how much you are willing to keep and how long it works for you. So financial independence is absolutely achievable. It is not dependent on how much you earn, how much is coming into your hands, but much more importantly, how much you are willing to keep and how long it works for you. I remember back in those days when I was in the ministries, there was this tag that they used to paste on the wall that take home is not able to take us home, which is true, even both for the poor and the rich. But the truth is that irrespective of how much we earn or how much comes into our hands, we are able to find a way to live each and every day. Those in the formal employment, when you don't have money in the middle of the month, you still go to work. Those in the informal sector, if businesses doesn't go well and you don't get sales as you used to, you still go back on a daily basis. It means that we can actually afford to save and invest and still live our normal lives as if nothing has happened. Once we have that mindset that we are committing to put aside a specific amount of money towards our future, towards achieving financial independence, once we can do that, it is only a matter of time and we will be able to achieve that. And let me end by, I am added this one to by Warren Buffett, who said that If you don't find a way to let money work for you, you will work till you die. But the truth is that we may not all be able to work till we die. Some of us may have to go off work before we die. So it's important that we take these conversations and discussions very serious and make sure that whatever that comes into our hands, it's seen as a seed, and we begin to put some aside for the next tree planting and the next fruit generation for the future.
Okay. So the bottom line is that irrespective of where you are, even in Africa and in Ghana, it is possible to achieve financial independence.
Definitely. But maybe, Jeff, just for the context of Africa, because of our extended family system, we even needed more than the developed markets where there's development. So the health services sector is better. When you're not well, you call a 911 or ambulance will come and pick you. Here, you will need to have money, and your expenses don't go away as you grow. They, in some cases, actually increase because of our extended family system and our developmental stage. So it's important that we commit to this financial independence. And it doesn't matter your salary, it doesn't matter what work you do. So long as money comes into your hands, you're a potential candidate for financial independence.
Great, 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 great. And to a question that I noticed that has already started coming in, I guess we will just zoom in straight to the Q&As. But my last question, and KB, I think this is where the meat of our discussion probably is. How do I achieve financial independence? In Ghana today, how do I achieve financial independence?
Okay. I think we first of all will have to start from making the money. We need to make the money. Then when we make the money, we have to manage the money. And in managing the money, we invest the money. That is the roadmap that leads to financial independence. So we need to work. We need to do something to generate income or earnings for ourselves. And we don't have to restrict ourselves, especially those in formal employment. Let's do anything that will help us legitimately earn more money. That's respecting the value of money, not doing 419 and shady deals to earn money, but earning money the right way in different forms as you can. And once you earn it, the next major thing is managing that money. And most of us earn money and spend the money without thinking of ourselves. And Prof. Adai used to talk about this 10-10-80 principle, where when you earn money, you pay your tithe 10% and you pay yourself 10%, and then 80% is for everybody. I'd say that anytime you earn money, you know how much has come into your hands. Before you even think of expenses, just tell yourself how much money I want to put aside towards my future or towards financial independence. Once you make that decision, you commit to it. The truth is that if you don't have the money, you can still live. So once you invest this money, the rest, you share it amongst all those that are depending on you. If they don't fit in this month, you let them come the next month. But let's make sure that we put something aside from all that money that comes to us into investing towards our financial independence. And then again, in that journey, it is not about putting the money in a savings account. It's about an active investment. And I will advise that people start off with collective investment schemes or unit trust or pension trust schemes that allows them to be able to put money aside over a long period of time to see the benefit of investing over the period. So make money, manage it, in other words, budget, and then invest money. These are the principles that would help you to achieve financial independence. And Jeff, just when I talk about manage money or budget is nothing but simply a lifestyle. If you plan your lifestyle, your budget will fit. If you live a life before you look at your budget, then it will not be possible. If you don't drink, you won't spend money on alcohol. If you don't smoke, you won't spend money on alcohol. If you don't wear black shoe, you won't spend money on black shoe. So budget is really about our lifestyle. So we need to sit down and look at our lifestyle and tell ourselves that this is the kind of lifestyle I want to live going forward. And the rest of the money, I am putting it towards my financial independence objective.
Okay. So the question, the principles are make money, manage money, and invest money. That will be your strategy to financial independence. We have a couple of questions, KBA, that I want to read with you to answer. I'll tie some of them in because they are about the same. I have a question from Bridget Beglo. She says, what is the best form of investment? Is it bonds or treasury bills? I think it's the same question that Abubakar Bawa Al-Hassan also mentions. Now, what's the advantage between buying treasury bills and then other investment schemes? So if you can kindly throw more light on what you consider to be the best form of investment.
Right. So best investment depends on who is asking and who is investing. The investment in itself is not wrong. It is when you mismatch the investment and what you are looking for, that is when it becomes a bad investment. So there are different kinds of investment. You have property investment, you have financial investment. Within the financial investment space, you have your shares, you have your bonds, you have treasury bills, you have fixed deposit. You also have collective investment schemes like the unit trust and the mutual funds we talked about. So all these investments have a particular lifestyle. And so everyone investing must map his objective with the lifestyle of that investment. If you mismatch, that is when there's a problem. So for example, equities are medium to long term, and they are for people who can take risk, because the price of shares can be up today and tomorrow it is down. An example is MTN. It came up on the market, moved from 75 to 90, then it dropped and is now hanging around 60 pesos, 70 pesos. Now, even though MTN as a company is a solid company and has a long-term value, if you had somebody who was looking for earnings or gains in a short period of time, you would have lost out and said that the investment is not good. But for a young person who is looking at value in the future, 5 years down the line, 7 years down the line, that is a good investment. Then again, in investment, time plays a key role, as well as your own investment objectives. So for example, I want to build. I'm ready to build in the next 3 years. So any investment that I can do from now to the next 3 years, that is great. When I get into my final year to build, I should be looking at investments that are very liquid, that anytime I need the money and I ask for, they can pay that money to me. I shouldn't be looking at the bond that is 5 years or 7 years, because at the time you need your money, the value may have dropped. But if you did a money market fund or short-term fund, because you are approaching the end of your objective and the monies are available, you can meet your objectives. So for investments, talk to your investment advisor, tell him your objectives, and then he will advise you as to which investment options are best for you. But to err on the side of caution, you can always go with a unit trust or a collective investment scheme that speaks to what you are trying to do. The second question on treasury bills and other forms of investment. Treasury bills are basically government of Ghana borrowing money from us, and then they pay back the money at different times with different rates. So if you see a 91-day treasury bill, it means that the government is borrowing from you for 91 days. And after 91 days, you pay back the money plus interest. Because it's government that is borrowing, it tends to be safer than any other form of investment. Although outside of Ghana, in Europe, we've had some government default, and even in Africa, we've had some government default. But governments are largely seen to be less risky because they can afford to print money in some cases to actually pay you when they borrow from you. So treasury bills are in the scale of returns will give you a lower return, but a safe haven to put your money in. So one would say you can't go wrong if you do treasury bills because you'll be paid plus interest. Any other investment apart from that should be giving you something slightly higher than the treasury bill rate, because then there's a risk that you may not get your money.
Okay. Thank you very much. I want to quickly follow it up with a question from Prosper Adongo, and he wants you to throw a bit more light on stocks in Ghana. So if you can speak a bit more about stocks in Ghana. You mentioned MTN, for example.
Yes. So when we talk about stocks, this relates to companies who raise money on what we call the capital market or from the public. So what happens is that the company is split into pieces. So like when you take around, let's say pizza, it's sliced into different slices, and then they price each slice. Each slice is referred to as a share of the company. Now, once you buy that share or that piece of the company, you become a part owner of the company, but you don't manage the company. The company has its own management body and staff who run the company. But whatever returns the company makes at the end of the year, a part of it, if they did well, can be paid to you as a shareholder who owns part of the company. Now, because they raise the money from the public, we have the stock exchange, which is also a place which allows for people to be able to buy or sell their shares at any point in time. So if you want to buy, the stock exchange is where the trading occurs for people who want to be a part owner of any company that is on the stock exchange, can get a piece of that. And when you want to sell, that is also the place that you can sell and then you take your money back. Shares is seen as high risk because the price is not stable and nobody can tell exactly what the price will be tomorrow. It depends on different factors: the company itself, the market environment, the economy, and things around happening to us on a daily basis. So we see it as a high risk investment because you can't really tell how much you will get out of investing in stocks. But historically, over the years, it's seen as an investment or an asset class that can generate much, much more than other asset classes, because there's no limit to where the share price of a company can go, whether it makes sense or not. As long as people are willing to buy, the shares will trade at that price. So the benefit of buying shares is, one, the capital appreciation. That is where the price of the share goes up beyond the price at which you bought it. And then also what we call dividends, which is part of the profits of the company that is paid to shareholders. These are the financial benefits. There are other benefits like voting rights, where shareholders during AGM can vote for the board of directors of the company to change the board of directors of the company. The risks are also that the price at which you bought it or you're holding it at today may actually drop far below that price. So you could actually lose your money from investing in shares. It is for those who can afford to wait and are not scared by the daily changes in the price.
Okay. Thank you very much for that explanation. Viewers, we would like to also throw in our question of the month. And our question of the month, once you get it correct, if you are the first to get it correct, you would get a pension voucher from Access Pension Trust. So please kindly listen to the question of the month, and you can answer A, B, or C. 3 winners would be given the pension voucher. The question of the month is this: which of these is the key principle for achieving financial independence? Which of these is a key principle for achieving financial independence? 1, or A, make money by any means necessary. B, avoid working in the formal sector employment. C, manage your money and lifestyle. I'll go over the question again. Which of these is a key principle for achieving financial independence? A, make money by any means necessary. B, avoid working in the formal sector employment. C, manage your money and lifestyle. The first 3 winners would be given pension vouchers. So please go ahead and answer the question in our comment section and our Q&A session, and we will announce the winners at the end of this session. KB, I also want to read a couple of more questions that have come in. And I'm taking this one from, I think we touched slightly on it, but from Ewenam. And she says, hi, Kwabna, please, how can I attain financial independence with the growing expenditure and responsibility I have as a youth? How can I attain financial independence with the growing expenditure and responsibility I have as a youth?
Yeah. So Jeff, that's a reality of life. Even if you ask the rich, they still have financial obligations that they dream and think about on how they are going to meet that obligation. But the truth is that if you look at the lifestyle of the rich, they invest and whatever is left, they spend. But for us, the poor, we spend and whatever is left, if any, we think of investing. Now, to break that cycle, we need to first of all start from the point of, I want to achieve financial independence. And this is how much of my salary I am going to commit to achieve that objective. Once you commit that amount, whatever is left, you would manage and you would survive. Then the other point too is that let's begin to look within ourselves, our passions, and the things around us, and see what else we can do. People have turned around their passions into money-making venture. They have 2 gentlemen who come to teach our 2 children how to play the organ and the keyboard and the clarinet. This is their passion in music, and they are making money out of that passion. So we need to look at making money and then managing the money. For me, these are 2 key things. Once we are able to make the money, increase our ability to even make more, and more importantly, manage it well by committing specific sums of money towards investing for the future. we will get to financial independence in our own way at the right time.
Okay. Okay. Paul Asiedu wants to know, how can we quantify financial independence? Can one estimate his or her level of independence achieved so far? So I guess what he wants to know is, are you able to measure financial independence, where your level is currently towards financial independence? Is that possible?
Yes, you can. And a simple way to do that is look at your expenses as of today, or even if you're looking at the future. Let's look at the future. By the time you retire or you want to stop active work, what will your expenses look like for the month? Multiplied by 12. It means that you need that amount of money on an annual basis. The question is, where will I get that money from? If I have businesses that generate that kind of money, then it means that I can actually take care of these expenses without having to go to work. If I have investments running and the interest from the investments is able to match this amount of expenses that I have to meet, then it means that I don't need to go to work to be able to achieve these or meet these financial obligations. So yes, you can quantify it, but make sure that you quantify it in your own lifestyle or budgetary. Don't put in things that is beyond you. Like in budgeting, we'd say, if you have so in budgeting, we have your incomes and then we have your expenses. Now, under your expenditure, we have variable cost and then we have fixed cost. Now, if your fixed cost hits 60, 70%, it means that you are living a lifestyle that you shouldn't be living. Because if your salary is, say, 1,000 and you pay rent of 500, already 50% of your salary is gone into rent before other things comes in. What it means, or what it is telling you, is that where you are staying is not where you should be staying. You should move to a place where you can afford to pay rent of, say, 200 cedis. So if you look at your total expenditure and you break it between fixed and variable, if your fixed cost is crossing 60, 70, begin to look at it again and tell yourself, probably the car you are driving, you shouldn't be driving, or the amount of electricity you are spending on a monthly basis, you should be putting off the AC more in order to be able to generate enough and then plan for financial independence.
Okay. Okay. There's another question from an anonymous person, and it says, is it advisable, KB, to purchase foreign stocks? Is it advisable to purchase foreign stocks?
So it's a yes and no. Foreign stocks or foreign investments, they have their place. The advantage you have with foreign investments is that you will benefit from the depreciation of the currency, in addition to whatever returns that you will make from those foreign investments. But you need to do a good comparison of what our depreciation of the currency has been, and then compare it to investment in cedi assets. If you look at our Government of Ghana instrument or bonds that are now trending around between 17 and 19%, and you look at a foreign investment that is giving you like 3% or 4%, say on the dollar, what it means is that if our cedi depreciates by 5%, last year the cedi depreciated by less than 4%. That means that if you add your 4% on the dollar or even 5% on the dollar, the maximum returns you're getting is about 9% or less than 10%. And that is less than if you had invested in a cedi investment. So you need to look at the economic situation of the country before you make that decision, because you could have gotten better if you're doing CD investment. But I might say that our currency is also not very stable all the time. There are those one-off years when we can have CD depreciating like 35% or 20%. If you take those odd years out, you realize that we'll have a stable depreciation that CD investment would actually outperform. However, if you have foreign obligations, like you have fees to pay or you have things to pay, which is linked to the dollar or the pound or the euro, then yes, it makes sense to match your liabilities to the currency of your obligations. But if not, and you're looking at it as a pure investment, then I would say do the math well, because you might be better off converting to CDs and doing CD investments than doing the foreign investments.
Okay. Okay. Elvis Amponsa wants to know, what strategies can one working in an informal sector adapt to attain financial independence in a space of 10 to 20 years? What strategies can someone working in an informal sector adopt in order to achieve financial independence in a space of 10 to 20 years?
I would say sign up for an investment plan, and then through Momo, anytime you make your sales, just ship the money off into the investment fund. I mean, if you take the likes of the Stanbic Cash Trust or the Stanbic Income Fund, you can use your USSD short code to be able to move money into your investment account. Any investment plan that has the platform for mobile money transactions, sign up for that investment plan. And once the money comes onto your mobile money account, just ship it into that investment. And keep doing this, whether daily, weekly, or monthly, over this 10 or 20-year period. And you will see the coming to pass of your dream.
Okay. Thank you very much, KB. It's been an amazing session, and I still see a couple of questions coming in. We'll try as much as possible to address all the questions that we have. If we don't, we would contact you again on this platform, and then we would respond to your questions. Let me also reiterate that you can reach Axis Pension Trust on 0302 738 555. 0302 738 555. And also you can follow us on all our social media platforms at Axis Pension Trust. The winners, before we continue, the winners for our question of the month are Mame Ama Insifo, Mame Ama Insifo, Eunice Topo, and Michael Mate. Mame Ama Insifo, Eunice Topo, and Michael Mate. So those are the winners for our question of the month. Each of them would have 100 cedis pension voucher, and kindly call our office number 0302 738 555 to redeem your prize. Of course, we will need identities when you contact us. So as we wrap up, KB, I also want to find out, and maybe for just maybe about the last bits of our conversation, given that we have indicated how to prepare, or the strategies for achieving financial independence, what is the step? What is the immediate step after this conversation that everybody needs to take? What is the first thing we all need to do after this conversation towards financial independence?
Number one, make the decision to do. And taking a cue from Napoleon Hill, he says that it's a burning desire, So make that decision and the commitment of the amount you want to put aside on a regular basis to achieve your objective. Now, if you want to have a sense of how much you should actually be doing, look at your expenses for the month, multiplied by 12. Let's say if it's expenses of 100 cedis every month, multiplied by 12, that gives you 1,200. Now, divide 1,200 by an interest rate, let's say 0.15%, that gives you 0.15. That gives you an idea of how much you need to have in investments to be able to generate the 1,200 on a yearly basis. So once you have a sense of that amount, which is your target or goal, then begin to commit a specific amount on a daily, weekly, or monthly basis, depending on how you get money. And then 2, when we have the benefit of good things coming to us, occasionally something, bonuses for those in employment, or you make extraordinary sales in the informal sector, make sure that you put a bigger or a part of that money into this investment plan. And then you open an investment plan. So you make the decision of how much, and then please get an investment plan from a trusted fund manager, and then begin to put money into that account on a regular basis. I say that consistency is a greater multiplier than speed. Once you are consistent over the period, you will achieve your goal. Don't wait till the last minute and begin to run to do anything. So make the decision, open an investment account, and then start.
Thank you. Thank you very much, KB. And we have had such a wonderful time. So for all of us out there who want to achieve financial independence, the simple step is for you to make the decision. And once you make the decision, that is where you begin. So let's all make the decision, contact the right people, and I'll direct you to Axis Pension Trust. We can speak about, you can talk to any of our financial planners, or you can also speak to any of the team from Stanbic Investment Management Services, KB and his team, and they will also be happy to assist you. On this note, we would like to bring to an end our session for this month on the Smart Money Talk. It has been an insightful session, and I'm sure you have learned a lot from it. I would encourage you to follow us on our social media handles once again at Axis Pension Trust. We have a program coming up next week, a pension strategy conference coming up next week. Please follow us on our social media pages and register to participate in this pension strategy conference. You can reach us again on our number 0302 738 555, 0302 738 555. KB, thank you very much for making time to speak with us. And I'm sure anytime we need any help, we can call on you again.
Definitely. Thank you for hosting me.
Very well. Thank you very much, ladies and gentlemen. And we would also see you again next month. Until then, stay safe, keep your mask on, and let's kick COVID out. Thank you.